As so, this may be once in a lifetime chance to build wealth because now can be one of the simplest periods to significantly improve your net worth if you know what you are doing. After all, there's an old adage that goes something like, riches are made in recessions, and it doesn't take a genius to see that we are heading in that direction. As of today, 9 out of 10 CEOs are preparing for a recession. 9 out of 10 are cutting expenses by 10%. And JP Morgan predicts the stock market might fall by another easy 20% from current levels. Despite the gloomy tone, recessions are a reality of life, and if you know how to take advantage of them, they may help you build a solid foundation for the rest of your life by providing you with wonderful chances and discounts. And so, this is Investing Path. And let's talk about what you may expect in the next 12 to 24 months, the best advantages you could enjoy right now, and the best steps you can take to maximize your earnings potential. But before we move on, please make sure to give this video a like and subscribe to stay updated for more of our future uploads. Now we won't keep you waiting for too long, so let's begin. Okay, so before we go into the most promising prospective prospects, let's talk about what we'll be up against. And the recession is where we need to start our conversation. Recessions are characterized by an increase in the unemployment rate, a decrease in earnings, a loss of consumer confidence, and a general decrease in the value of stocks, food, energy, and services with potentially long-lasting impacts on the global economy. However, secondly, a drop in income is commonplace during a recession. Let's start with the earliest of these stocks. All three major indices are currently down between 20 and 30%. From what we've heard from respected institutions like JP Morgan, we still have another 20 above ground. However, if we go back to the history of the market from 1946, we find that the average bear market drop was close to 30%, with the worst being in 2009, when the SP 500 plunged 57 from its peak. Historically, bear markets have performed significantly worse during economic downturns, falling by an average of 34.8%, compared to the current decline of approximately 25%. In the following moments, we will detail just how much money you can make. Second, we must address the topic of property. Although local conditions vary and some areas may continue to prosper, nationwide housing decreases are extremely unusual. As can be shown, price declines of more than 10% have occurred only a handful of times over the past 60 years. However, the current assumption on Wall Street is that the national housing prices will fall by 7%, with a worst-case drop of 10% to 15%. The most vulnerable markets, which include sections of Florida, Arizona, Idaho, and Southern California, could experience upwards of a 25% decrease from the peak, according to Moody's Analytics. And the decline could linger for another 12 to 18 months before bottoming out if interest rates continue to rise. We can now look at the bigger picture. It is obvious that until recently, people have believed that money is being lost to inflation. However, cash could be the safest location to deposit your capital when all other assets are declining in value. The truth is that many people don't remember that cash was the top performing asset as recently as 2018. As a result, fund managers are hoarding the most cash they have been hoarding since 2001, and according to Citigroup, cash is the only asset investors can use as a recession hedge. If you're wondering how this relates to making money though, keep watching. Okay, so just to consider first why the next recession could be once in a generation chance. Prices drop across the board. Even if one person thinks this is a poor time to invest, we still think you should because everything is down 30%. If a wealthy person heard that they could buy the same companies for a 30% discount, they could jump at the chance. People lose interest in equities when their value drops and they can do better elsewhere with the same amount of money. First, you need to rethink your thinking, as a declining market may actually be to your benefit. That's because, second, you'll have less trouble standing out. When times are tough, businesses cut back. Some even go out of business entirely. This, however, provides an opening for newer, more daring businesses to emerge and replace them. When the recession ended, one survey of 16,000 businesses found that those who kept advertising had the greatest value and return on investment from their efforts thanks to positive growth. In the third, there is a lot more room for growth. A few months ago, Patrick Matt David offered a brilliant analogy that the peak of the market cycle is just like a forest, and the recession is the market's way of thinning away the undergrowth. Because of this, only the largest and most well-established trees or businesses benefit from the full spectrum of available light. Everything at the bottom has a tough time competing and expanding. However, our economy has a tendency to periodically weed out and bankrupt corporations that are no longer viable, opening the way for fresh, smaller businesses to flourish. Finally, bull markets always follow bear markets. According to Yahoo Finance, the average decline in the SP 500 surrounding a recession has been 29 points, with the median decline being 24 points. When stocks hit rock bottom, however, they typically rise by 40% the next year. In addition, the market has expanded by almost 58% on average in just the past 2 years. As a result, putting money to work during a market decline is preferable to waiting it out. The market has always recovered over the long run in every historical instance. Fifth, you need to take action before word gets out. We realize how simple it seems. In reality, however, recessions are never proven until much later. The Great Recession, which started in December 2007, was not formally recognized until December 2008, just a few months before it ended. However, cutting costs is the first and most important thing you can do to turn a profit from this situation. This includes keeping a close eye on the market, reducing frivolous spending, and running a lean business in order to reinvest as much as possible in the market. In addition, you should consider what you would do if you lost 20 to 50% of your income, how you would make up the gap, and whether or not you could take any precautions now to avoid such a scenario. Number 2. Set aside some money. The percentage of your portfolio that is held in cash fluctuates from 15% to 20% throughout the year. But generally, this has provided us a lot of chances to seize advantageous bargains when they present themselves, and it allows us to rest easy that we have a safety net in case the worst should happen. Third, guard your employment status. In the end, this is your safest bet against potential problems, because the worst thing can happen to you financially is not a drop in the market itself, but rather a drop in the market plus the loss of your employment at the same time, forcing you to liquidate your investments, just as they are in the lowest point. In other words, you should make the most of this opportunity to develop yourself, acquire new abilities, and accelerate the progress you've already made. After that, the next for investors are long-term thinkers. The greatest strategy for investors is to operate as if nothing has changed and keep putting money into the market. Investing in the markets on a consistent basis, also known as dollar cost averaging, has been proven to yield the best returns. Therefore, it is advisable to maintain an investment in the market by making further purchases. As for number 5, spread your money around right away. If you're so heavily invested that you'd panic if the value of your portfolio dropped by 20%, you should probably scale back your exposure. For instance, if all your money is invested in small and medium cap US equities, you may want to reconsider diversifying into larger companies, overseas stocks, real estate, or real estate investment trusts. Because rents in these sectors are typically more stable. Your portfolio will be more stable if it has a wider base from which to support itself. We think it makes a lot of sense to keep making purchases as usual. Keep some cash in hand for use in starting a business or purchasing property after the market has leveled down. The timing is right to ramp up your efforts, start something new on the side, and absorb as much information as possible. Why? Because when the market rebounds, the benefits of your actions today will multiply many times over. It's not going to be simple, but those who persevere will reap the benefits. Now, once again, this is Investing Path, and we thank you so much for watching. Please make sure to give this video a thumbs up before you leave, and while you're at it, hit the subscribe and bell button as well to stay updated for more of our personal investment and financing content. Other than that, thanks again for watching, and we'll see you on our next video.